in my early to mid-50s because they do things for your pension. And I don't control any of the assets in my pension. I just let someone get on with it. Someone who knows far better about running money than I can ever know. But one thing they do is it's called lifestyling. Actually, why don't us just say hello to our next guest? Ozan Özkural joins us now. He, of course, joins us as managing partner from Tanto Capital Partners. Now, you're not as old as me, so you don't have to worry about your pension either. But they do something called lifestyling, which is as you get older, they think you want less risk, which is probably quite logical as well. Yeah. So they put you into more bond-type products and take you out of some of the racier equity products as well. So, you know, you don't get so much upside, but you get a more solid return. That's the theory. It's kind of like a barbell, as we've heard. But what happens next then is, though, they put you into something like the gilt. You think, oh, it's safer. Well, for goodness me, look at the gilt performance over the last couple of years since they started putting me into more of it. Oh, God.
But you get the yield. You get a juicy yield.
I get a fatter yield all the time, but the problem is the underlying is struggling. Ozan, you've just had to be... How are you?
I'm good. How are you?
I just needed to get that off my chest.
I was just thinking that the biggest risk is not taking any at all, Steve, so...
And that's exactly the point, isn't it? I mean, it's been a racy old 2024. In fact, I'm going to be indiscreet and say that off-camera, Ozan said it's been 18 months this year. It really has felt like it, hasn't it? So but you've had to be invested. You've had to be invested. And the bravest investors this year on risk have been the ones who have been stunningly rewarded.
That's right. And I think this year we have seen an example of what we call American exceptionalism. Yeah. Now, that word is overused and sometimes too much attention goes on to that. But I think we have seen a year where investors that have been risk-on and proactive in the markets have been rewarded.
It doesn't work every year, but it's...
No, it doesn't.
Why, just tell me what I think I know one or two things, but I want to know from you, why has that worked so far in 2024? And then obviously the next question is, we'll talk about next year.
Because you know what, we have been in the middle of an incredibly fast news cycle. The world is changing. There's so much volatility in the market. It has not been a static year. And as opposed to being reactive and going through what, if you will, an investor would have done perhaps in normal years, one had to be ahead of the curve as much as possible. And that meant dynamically and proactively managing portfolios, trying to assess risk on the go.
Oh, come on. Just own 5 or 6 stocks. You don't have to... you sound like an active manager, but just own 5 stocks, you're fine.
Well, look, that's not going to be sustainable.
No, and that's the point, isn't it?
No, it's not going to be sustainable.
But 2024 was... Just own this stuff, wasn't it? Really? I mean, you could pick... I'm not saying you'd have picked NVIDIA, but yeah, a bit of Novo Nordisk in there, bit of NVIDIA, bit of Amazon, bit of Meta, bit of Apple, bit of Tesla, maybe. Yeah, certainly Tesla.
I think the issue with that, Steve, is that a lot of portfolio managers, a lot of wealth managers have so much of this stuff in their portfolios, they're kind of locked into needing to double down on this. And that is a potential problem in the future. It's a self-fulfilling prophecy until it's not.
Yeah. So that's the biggest risk, being part of this massive consensus trade and the FOMO trade and the momentum that's been going on. Is that really a risk? You're not really going to miss out on something. Isn't the bigger risk not being invested in something like, let's say, the Chinese equity markets?
Well, it's an interesting one. I think it depends on your world outlook in terms of what kind of a world we are going to be looking at. It's funny that you mentioned China. So yes, of course, have your NVIDIAs, Microsoft, Amazon, Apple, whatever it may be, your Mac 7s in the portfolio. But just going long these is not an investment thesis, I think. You have to have them. And I do think that going into 2025, I do believe that the American exceptionalism will continue to persist, especially in comparison to other developed markets, in particular the EU. And Steve and I have a bit of a pet peeve of talking about, is EU really that bad of a jurisdiction versus the US? I think so. And look at the news that we're seeing today with UniCredit and Commerzbank.
I'll just comment on something, because I think my point is, if I'm correct in remembering my point, which I don't remember what I had for breakfast, in fact, I do know what it was, it was pretty revolting, is that Europe isn't European companies, and European companies aren't Europe as well. And I believe strongly in the best-in-class in Europe. I mentioned Novo Nordisk already, I could add SML, I could add Schneider, I could add loads of them. I believe strongly in the best-in-class in Europe, and I believe that the problem is that their destiny is being looked at from investors as the same as the countries they have jurisdiction in. I think there is a strong difference. That's my point.
I think your point is absolutely valid. With the world that we are going to be living in next year with potential Trump tariffs, and let's just face it, a much more dislocated global system with supply chains coming under pressure, with regulators and governments, and by the way, fiscal policy taking a much more of a prominent stance versus monetary policy, these companies that are headquartered in the EU and are somewhat dependent, or even though not 100% tied, into the European legislation, will potentially find themselves at a disadvantage compared to their US counterparts. I mean, look at the Commerzbank, UniCredit Commerzbank potential acquisition/merger. And you were talking about this earlier in the program.
Yeah.
European Union wants a larger financial institution, yet there is pushback from Germany. Why?
I don't
Why?
know. Nationalism.
Correct.
Okay, you tell me you're German. Why?
Oh, absolutely. Nationalism. Loss of jobs. You know, it's the oldest story in the book.
But the oldest story in the book is if you let the private sector proliferate, you will create jobs.
Well, you're right. Let me ask you about the geopolitical risk, which is not going away. And Steve makes this point all the time. Let me borrow that from Steve. Do investors know how to trade around that risk? Do they have any feeling? Or were they just really lucky this year despite the geopolitical risk because they had all things AI going for them?
Most of them, that's a great question. Most of them...
It's Steve's question.
It's a great question, Steve. most of them were lucky. But I do believe that people and corporate boards, not just investors as per asset managers, but also corporate boards are getting used to the idea that geopolitical risk is something that will need to be priced much more effectively, and that starts with intention. It starts with intention around corporate boards, around asset managers to try to understand what geopolitical risk is. And by the way, that is not static. And it is not just about the Middle East, not just about Russia, Ukraine. As you move on to a world with regional superpowers becoming a reality, dynamics will change. Whether it's supply chain dynamics, financing, nearshoring, friendshoring, energy security, you name it, we have it. So 2025, I think, will be a year where asset managers and investors will have to be intentionally looking at geopolitical risk and trying to understand. Will be a year where asset managers and investors will have to be intentionally looking at geopolitical risk and trying to understand how dynamically they can price it, not just reactively.
So investors have made a lot of money when it comes to some of the liquid stuff. Equities, bonds to some extent. What about alternatives, less liquid stuff? How much of that should be in your portfolio?
I think it's a great question again. I think it depends on which jurisdiction you're looking at and what type of illiquids we are talking about. I mean, if you're looking at emerging markets, that's a very different story. I think we'll see a lot more differentiation in emerging markets. So if you're going for some illiquid trades in EM, be very, very careful. If you're looking at developed markets and especially US markets, you may end up having some element of illiquid assets in your portfolio just because the pricing of illiquid assets are done easier in the US than they will be in emerging markets.
Let me squeeze in one. I'm very naughty. Given the cost of money will probably carry on going down in 2025, albeit we don't know the pace, given this disparity between European assets and US assets will continue and expand, given that that means probably the dollar strength will continue as well, I see that as the biggest green light in maybe in a generation for US companies buying European companies.
I think that's a great point, Steve. I'd agree with that.
I'll leave it at that then. I like
we have agreed on something.
We agree on everything. Lovely to see you.
Great.
And we'll
Likewise.
spend a lot of time together, I'm sure, in 2025 as well. Maybe
Great.
CNBC will send me out to Istanbul at some stage for
Why
some
not?
coverage. Why not, indeed? Why not?
Why not, CNBC?
Why not, CNBC?